Welcome to the show. I'm Andy Hagans, and today we're talking about the tax benefits of investing in oil and gas, as well as how we can mitigate risks as LP investors. Joining me is Steve Blackwell, CEO at Invito Energy Partners. Steve, welcome to the show.
Thank you for having me, Andy. I am excited to be here, talk to your audience.
The timing, I think, is great. Talking about tax benefits, we're in Q4 here, as we were discussing before we started to record. Also, the price of oil pretty high right now, so I'm
Yeah.
noticing there's a little more attention on this sector than there was a year ago. Would you say that's fair?
Yeah, I would say that's absolutely fair. Prices have been good for, especially the balance of 2023, and who knows where they're going to go with what's going on over in the Israel-Palestine conflict. So that could make them skyrocket, but who knows?
Yeah, and I want to dive into all that, all the risks, the opportunities. But before we dive in, I always want to start with my guest's background. So, Steve, tell us about your background. How did you get into oil and gas?
Yeah, so let's see, I went to school at Central Michigan University. I have a degree in finance and accounting. I spent my first 16 years actually in the mortgage banking business. So I'm old enough to have lived and died through the 2008 financial crisis, which was a big blow to the mortgage industry. And so basically at the age of 36, I had to wake up and find a new career. And I ended up going to work as a consultant in an energy business because my background was really as a kind of a corporate manager. I've been running large divisions or large territories in a medium to large size corporations. And anyways, long story short, I started out as a consultant. Within a year, I was the president of that company. And then over the next 7 years, we had a fantastic run in that company. Invested in about 5 different projects. 3 of them are operated, 2 of them are non-operated. We put to work about $300 million, and we exited out of those projects for just under a billion, just over, it was about $1.1 billion. So had a great run. And then I went into I took some money off the table when we took some private equity money. I had a Pete. I stand out for a couple of years, jumped back into the industry, was the COO for another a company that was a company that raised money through the private space, which is really what gave me a taste for seeing the private capital side of the business and was really a genesis for Invito Energy Partners. And a few years ago, not the greatest timing in the world, we launched Invito right at the end of 19. So, a couple of months later, COVID hit, the world shut down, and oil demand dropped, and oil prices dropped into the negative territory. So I think
Yep.
we might go down as the worst timing ever. But you got to have resiliency and just push through. And we're still here and excited about, especially where the oil and gas industry is today.
Yeah, I have a theory, and I think I've seen some data on startups and companies that launch during tougher economic times. It's like I think it can be a really good thing, actually. It's like it imbues your company DNA and your
Yeah.
whole, management viewpoint with that sort of attitude that you're talking about.
Well, perseverance is, I mean, you either have it or you develop it. That's for sure. And when you start a company, right before, I don't even call COVID a once in a lifetime event. That's like a once in a forever event. At least for the people that are alive today. So yeah, it'll definitely teach you how to persevere and believe in what you're doing.
Absolutely. Well, big picture, I always like to start with the question, are you an energy bull? I assume the answer is yes, but I want to talk about why. So obviously you launched Invito in 2019. You are an energy bull, but why? What are the big picture factors that really make you confident in that sort of a long-term investment?
Well, look, first you have to start on two sides of that equation as far as I'm concerned. First, let's talk about the demand side of the equation, right? With all the ESG talk these days, there's a lot of noise around oil demand going away. The reality of it is, pre-COVID, the world was consuming about 100 million barrels a day of oil. And post-COVID now, we're up to almost 102 million barrels today. All the projections, whether it's the IEA or whoever you're looking at, is projecting oil demand to grow over the next decade or next 2 decades. And that's because the reality of it is the developing countries, China, India, they are desperate for energy and they're continuing to grow, and especially their middle class. China's a little different in that area, but they have a huge demand for increased energy needs. And oil is not just, even though it's about 55% of it's used for transportation, the other 45% of it is in refined product that goes into the production of probably 6,000 different products. I mean, it's literally, our world does not exist as it is today without oil. It's in the clothes we wear, our computers, our cell phones, on every road we drive on every day. It's literally in everything, medical equipment. So the demand for oil isn't going anywhere, contrary to what some might want you to believe. Electric vehicles may have some pressure on that in terms of demand side, but honestly, electric vehicles have more of a pressure on the natural gas side of the equation versus the oil side, right? Because natural EVs need to be charged, and they're charged with electricity that's made by fossil fuels. Let's not go there for now, but that's natural gas, so that's not really oil. So,
Yeah.
so I'm bullish big time on the demand side of the equation. And then, so let's talk about the commodity side, because really commodity price side is the next part of that equation, right? And so fundamentally, oil commodity price always trades on supply and demand. There's always going to be things that are affecting that, such as what we're seeing today. But long term, it's always a supply and demand equation. And so there has been so much, the development of oil hydrocarbons or resources is extremely capital intensive. And over the last probably 5 to 6 years, there's been an enormous amount of capital that's been pulled away from the energy industry. A lot of that, quite frankly, is from the ESG pressures. A lot of institutional capital is pulled out. A lot of the equity capital has been pulled out from the markets. And of course, a lot of the areas that are used to be open for exploration, especially on federal lands, are not open. So all of those are downward pressures on supply, and you have growing demand. So that's bullish in my opinion. If you look at the last decade, you had probably, if you took the closing price, settlement price each day of WTI, it was around $64 a barrel. It would be very easy to make the case that the next decade could easily be $10 higher or more. So that's why we're bullish. Natural gas is a little bit different. We're more of a favor of oil, but natural gas, only because we have so many reserves in this country for natural gas. And most people don't understand is oil wells also produce gas. So the associated gas that comes with oil wells fights against the pure natural gas plays in terms of supply. So, but natural gas is still a very favorable commodity as well. We're just more bullish on oil than natural gas.
Understood. And what you mentioned, talking about the supply side and how ESG has affected, investment decisions from pension funds, corporations, asset managers, all sorts of, government agencies, government policies, just so all of the, what I would call big money. So it's interesting, I don't want to sound like a populist, but usually as a private investor, as a little guy, the deck is stacked against you. This may be one of those rare instances, whereas an independent accredited investor, as a self-directed investor, you may actually have that advantage because I'm not surrounded by a boardroom of people trying to posture by, out progressiving each other with energy policy or something like that.
Yeah. Well, it's a great observation, because one of the opportunities that's presented itself with so much institutional capital being pulled away, private equity included, who's filling the gaps? Private capital. Private capital can't fill all of the gap, but it's attempting to fill those gaps. And the industry is capital intensive. So what it's producing is an opportunity for private investors to participate in projects that maybe they wouldn't have in the past. So it's a great point.
So you're talking about a GP or a sponsor.
Yeah.
Maybe they're raising, let's say, $50 million for a project, and if you look at the underwriting, an experienced person looking at the underwriting would say, well, this is a slam dunk. And 20 years ago, they would have had no problem getting some sort of institutional investor to say, yeah, well, we'll invest in this.
Yeah, absolutely. capital stack would have been filled by PE, some sort of other institutional capital. Today, private capital has the opportunity to step in. So the opportunity is definitely affording itself to the private side, which is great for what we're doing.
Are GPs and operators spending a lot more time fundraising now because they have to? I mean, it is kind of an administrative burden, if nothing else, or a time burden, I suppose, if you have to raise capital from, dozens or hundreds of investors versus one or two or three.
Yeah, it's definitely a trade-off, right? I mean, when you have institutional capital, it's not all pros on that side, right? There's usually a lot more governance. There's usually a lot more triggers that come with that money in terms of what they need and what they're watching and what they're looking for. And so you have all your capital coming from one space versus on the private side, maybe it's a handful of people. There's more flexibility. They might partner, function more as a partnership rather than, just an oversight. Because sometimes a PE firm will act in a certain way towards a fund or towards a sponsor because they're having problems somewhere else, right? And so the fact that you're getting affected by something else that's going on inside their institution or their cap stack has nothing to do with you. They both have pros and cons, but yes, it's definitely more labor when you are raising capital, especially if you're raising it from the retail investor. It certainly has a lot more work to it than getting your money from one source.
Right. There's a point at which it is a little less efficient, as an LP. Like, I think on both sides of that sort of LP transaction, because as an LP, if you're investing in chunks of $50,000 or $100,000 and with different sponsors, different operators, it's cost prohibitive to get really good due diligence. Like, right, if you're investing $50,000, are you going to go out and spend $20,000 on professional due diligence, right? So, I mean, that to me is I don't want to say it's a problem, but it's a challenge, at least, I think, for retail investors.
It absolutely is. So I think, when I talk to people about, because I do investing on my own besides, into oil and gas, right? So, and I've invested in a number of LPs, whether it's commercial real estate or private equity or private credit or whatever it may be. I think there's some like a few pillars that you have to do. First of all, you just have to do the work yourself, right? I mean, I can't tell you how many people don't read the PPM. You got to realize, when I always tell people they see a PPM and it's 300 pages long or 200 pages long, I always try to say there's about 30 pages that matter, because the rest are it's just all legal stuff that the lawyers put into every PPM. But you got to read your PPMs. You have to understand the fee structure. So that's one of the most critical things in my personal opinion on private placements is how is the sponsor making money, right? And does that fee structure align with how you are making money and create alignment between yourself and the sponsor? And obviously you want to make sure that there is not over promotion into the project, which can be unfortunately the case a lot with oil and gas. The second part of it is you need to understand, obviously, the time frame, the illiquidity or liquidity events, if it's possible. Most of them are not liquid, so you can't put capital into these types of investments that you need back. And then the other part of it is, significant due diligence on the operator themselves, the sponsor themselves, in terms of, that's just asking questions. I mean, you can do some research, you can go on LinkedIn, you can Google people, look at their backgrounds, and is their background in the space they're operating in? Mm-hmm. So for the perfect example would be is in oil and gas. If I'm looking at an oil and gas deal and I'm looking at the sponsor, to someone bringing the offering to me, and their background primarily is commercial real estate, and now all of a sudden they're in oil and gas, I'm just going to tell you that's a red flag that you better be careful, because oil and gas is a very technical business. So same thing would be the flip side. If I'm pitching you a self-storage deal, and I've never been in the self-storage industry, well, you might want to question what my experience is in that. Unless I have a really deep team underneath me, you want to be careful on that. So you got to understand how the deal's structured. Does it create alignment? Make sure you don't have egregious fees. And then what is the experience of the sponsor? And so you can do that due diligence on your own. And then, of course, when you look at return projections, if it's too good to be true, what does that mean?
Totally. Yeah. And,
It's too good to be true.
right. Well, you mentioned due diligence on the sponsor. And, when people ask me about due diligence, I kind of get multiple answers, right? I'll be like, okay, here's what I'm supposed to say, right? I'm supposed to say, have everything professionally due diligence. But I also understand in the real world, a majority of LPs do not do that, right? They don't go out and
No,
pay for a professional. That's just the real world. So then I'm like, well, is a kind of a lowest common denominator. If do something, right? Like what you're talking about. If you're not going to pay for professional due diligence, then you're taking on that responsibility on your own.
yeah,
And I think that maybe the most important thing is due diligencing the people, the company, their track record. I think with oil
yeah,
and gas, really with real estate as well, the track
absolutely.
record over that full market cycle. I mean,
Yeah,
ideally, it's a team that has seen multiple full market cycles and they've been around for all of them versus we're appearing just when things are starting to get frothy and our track record is just the past 6 months or something like
yeah,
that.
yeah. I agree. The track record is important. The track record doesn't have to be with the same company that they've always been with because people move, right? But
Yeah.
if you're looking at a company that's 10 years old and they've had 10 years of funds, obviously you want to do the due diligence on the track record. If they've been around 20 years and you can see 20 years of funds and 2 out of the 20 have returned capital,
Right.
enter at your own risk is what I would say,
Totally.
regardless of what they're telling you. You have to be avoid being sold, right?
Yeah.
That's what you have to avoid is being sold. And then just understanding the rest of it. And I think other small things like, like for example, we have a data room online through a platform called Tribexa. We've paid for background checks on myself and my partner because I think it's important to. Those were expensive, 1,500 bucks a piece. But I think it's important to know that we don't have a criminal track record, but beyond that, that we don't have bankruptcies, tax liens. If we're fiduciaries of money, you would want to know that we've been responsible with money in the past. It doesn't mean to say that there couldn't be a situation that could be understood or explained, but you would at least like to know that. What you don't want to do is get into an investment that doesn't work out. Turns out the person, was involved in multiple bankruptcies, had tax liens on their record. That's what you want to avoid.
Right. Yeah. And I'm an alternative investment guy. So I'm the last person who's going to be bad mouthing alternative investments. But what I like to say is there are good operators in pretty much every sector, like a
Oh yeah,
lot of them. So there's really no reason, to go with
yeah,
someone who's not solid, who doesn't have a good track record, because there are plenty of options that do.
yeah. I agree 100%. And I'm an alt asset, so I believe in it as well. But on my own personal investing, I am uh, you know, personally, I'm in the process of changing the construction of my own portfolio to be much more heavy weighted towards alternatives. I'll be 55 next year, and I'm just not really into sitting through another 2008 or even what happened in 2022. I mean, in 2022, the S&P went down by 20, the Nasdaq went down by what, 31. What people don't realize is how long it takes you to get when you lose 30% in an
Right.
equity, you don't have to get a 30% gain to get back to break even. You have to get about a 50% return to get back to break even on an equity portfolio. And so, I mean, that could take years.
Right.
So,
And
yeah, I'm in the same process myself, so I'm a big believer in all as well.
well, let's talk about that private investor side, because again, as I mentioned earlier, there's a lane for private investors, and one of the beautiful things about oil and gas. So we have the market fundamentals that I believe are very favorable. I have skin in the game. I'm an LP in oil and gas. But then also as a private investor, you get these tax benefits, right? And that's uniquely of benefit to a private investor are these tax benefits. So I want to, talk about those a little bit, maybe go a little deeper, cover some nuances that some of the audience might not be aware of. But why don't we just start with the basics? If I'm an accredited investor, maybe I'm a dentist, a surgeon, a technology, computer developer, whatever, but I'm high income. I'm interested in your fund. You know, explain like I'm five. What are the tax benefits of investing in an oil and gas deal?
Yeah, yeah, I can do that. Yeah, so the big deduction with oil and gas is called the IDC deduction. So it's called the intangible, which stands for intangible drilling cost. And that is, I believe, IRS section 263C. So it has been around. It was put in place, I believe, back in the 70s. Really, as Congress will do, right? They'll use the tax code to incentivize behavior. And so the United States, pre 20 years ago, was, a 3 to 5 million a barrel producer of oil, and 15 to 20 million in consumption. So we were importing, thousands of barrels a day from foreign countries. So we were so foreign oil dependent that they were trying to incentivize people to put capital towards the exploration of hydrocarbons in the United States. So what the IDC deduction does is it allows you to take, so when you drill a well, so let me start here. When you drill a well, so what is an IDC? When you drill a well, there's two primary costs. There's the intangible drilling cost, which is essentially anything you put into the ground when you drill a well, that when you're done with the well and plug it, there's no salvage value. The other portion of it, and intangibles are typically low side 75, high side probably 85% of the total cost of a well. Okay. The other portion of the cost is what's called tangible drilling cost, which range from 15 to 25%. The tangible is just the opposite of an intangible. Anything you put into the ground that when you plug the well may have salvage value, like the casing, the pipe, or production equipment. So back to the intangible drilling cost. So let's just say a well costs $1 million to drill, and the intangible drilling costs are 80%, so $800,000. The IRS through 263C says you can take 100% of those costs, so 100% of that 80%, and write it off in the year of investment. So the way that works for an LP, or really you come into the it's a limited partnership, but you have to come in as a general partner if you want to offset ordinary income. So when you get your K1 in March of the following year, the other huge benefit is you can take that 100% of the IDC write-off, flow it through, and even though this is a passive investment, and here's the huge benefit, you can offset ordinary income. So that is what makes oil and gas, from a taxation benefit standpoint, extremely unique. There are very few investments out there that allow you to take a large write-off up front and offset it against ordinary income, even though it's a passive investment. Some cost depletion, deals within, commercial real estate may afford that, but you have to qualify as a real estate professional, right? So if you're a doctor, chances are that you're not going to qualify as a real estate professional. And so it's going to be a passive loss. So it's only
that threshold, to what I understand, at least, that threshold is pretty high. It's not just like, you can't just spend 5 hours a month doing some side real, there's a pretty strong litmus test whether you can.
It's not easy to do. So you may have a great deal with a lot of cost segregation in it, and there's a lot of good commercial real estates do, but it's typically going to be a passive loss. So that's the huge advantage of oil and gas. If you have a W-2 job, a 1099 job, or even a business that doesn't have a lot of write-offs, and you're making a lot of money, there's just not a lot of ways anymore to reduce your taxable income. So you can make an investment into oil and gas. Let's say someone makes a $100,000 investment into oil and gas, and the IDCs, the intangible drilling costs for that year, are 85%. You're going to get a K1 that shows an $85,000 loss. So for year zero, which I always call the year of investment, it's just partnership accounting. So it's not really that complicated. You just get a K1 that shows an $85,000 loss, and that flows through to your Schedule E and flows through to your 1040. And it's an above the line deduction. And what I mean by that is you still get all your other deductions, right? So whether you're taking the standard deduction or you're itemizing, after you take all those deductions and here's your AGI, if you have an $85,000 loss, now that AGI drops by another $85,000. So it's an instant built-in return, and there's very few. I would never use the word guaranteed returns when I'm talking about investments, but this is pretty close to a guarantee, because unless you're doing something wrong, you're going to qualify for that. But you do
and at the top marginal rate, if we estimate and say your marginal rate is 40%, and then you're deducting 85,000, that's going to be something like $33,000 of instant tax. I mean, so that is, I don't want to call it guaranteed return, but it kind of, like, you're locking in that cash flow, that cash back. It's kind of like an instant cash back rebate kind of thing, or
I
saying,
mean, it's from a present value standpoint and a reinvestment rate standpoint. It's a really great way to grow your wealth. So
yeah.
yeah, it's an unbelievable benefit in the way that it works. You have to come in as a general partner though.
Yeah. So Steve, a couple things I want to dig into. One is I'm reminded of I think it was a Seinfeld episode where Kramer was referencing write-offs, and then you don't even know what a write-off is.
Yeah.
It's not of value to take a loss on an investment or to have a write-off if the investment is not ultimately profitable, right? So that I'm not saying that that is the case with your company or any one specific company, but I do think that in general, I always tell investors, don't let the tail wag the dog, right? Like the tax benefits of oil and gas or of real estate are great, but you still want to make sure that the underlying investment is a profitable investment, right?
It's 100% true. So if you invest just for a tax benefit but lose your money, did you really make money? The answer is no. So so the tax benefits are great. It's a great it's a great reason to consider oil and gas as a strategy within your portfolio, right? Deduction. And additionally to that, the tangible costs can be amortized, and so you'll get those over time. And then you have the small producers exemption. Just as another side note, when the cash flow starts to come through distributions, you have what's called deplete allowance, and you only pay tax on 85% of the income that comes to you. So a lot of incentives in the code for investing in oil and gas. That said, you're 100% right. Put in $100,000, make 35 grand in tax benefits, but lose my $100,000. Didn't work.
Right.
That's not an investment. So you have to understand the rest of the investment, the risk profile to it. You should be with a sponsor that can articulate to you how they choose assets and how they manage risk and how they underwrite risk inside of an oil and gas portfolio. 100% correct.
And on the note of risk, there's one thing I wanted to follow up on. You already alluded to it because I get a lot of questions about this. Even just in general, like hosting the alternative investment podcast, this is a topic that comes up really anytime anybody mentions oil and gas deals, upstream, oil, is that GP versus LP difference and the ability to offset active income versus passive income. But there's no free lunch, right? There's no totally free lunch, at least in the sense that some investors do elect to come in as an LP, right? So then any losses they can offset against their investment income or their passive income.
Correct. Yeah.
So why would someone elect then to be an LP versus a GP? I mean, I'm presuming it's always because of less liability. Is that right?
No, the only reason people ever go to the LP side is because they're an investor that has a bunch of passive income. So they're very heavy into alts already, and they're making a bunch of money off their investments. So they have a bunch of passive income they're trying to offset. So if that's what you're looking to offset, you just choose to come in as a limited partner.
So it's pure dividing my income and finding out which one that I need the deductions. There's never, are you basically saying there's no increased risk if I'm listed as a GP in an oil and gas deal as an investor, as really a passive investor?
So technically, as a general partner, you are at risk. That's why the IRS, that's the caveat the IRS is using in their brains, or whoever wrote this in the 70s, to say, okay, you're not a passive investor, we'll let you offset ordinary income. Now, that said, so how do you manage that risk for your investors, right? As an operator of an asset or somebody that's into oil and gas. So like our fund, for example, we will invest in wells that we operate, but we will also invest in other operators' wells so that we get a good mix and we can manage risk inside of our own fund with diversification. But how do you manage that risk? So when you look at our data room, you'll see two sets of documents in there. The first one is our own insurance coverages, right? We want to make sure that we have proper insurance coverages. But the second one is called a master service agreement. So even though I'm the operator of record on a well, when we go to drill that well, we're not the one. We hire a drilling rig company, a service provider, to drill the well, right? So we don't own a bunch of drilling rigs. That's very expensive. So we'll hire a company to bring out their rig and their crew to drill the well. And for every vendor that steps on foot on location, you have in place a master service agreement, and you can manage that process yourself. We third party that just to make sure it gets done, right? But those master service agreements have what's called circles of indemnity in them. And right. And so what the circle of indemnity says is I'm responsible and liable for my people on location, and you service provider are responsible for your people on location. So when we have the drilling going on, and it's a big drilling company, they have huge insurance policies, and all the employees on location, save for maybe one, are all their employees. So if something happens during drilling, right, you would have first the insurance policies of the drilling company, then they would, the insurance companies of the operator. And my entire life, it's just like a car accident, right? The lawyers just go after the insurance policies because that's where the money's at.
Right.
I'm not saying it couldn't happen, but I've never heard of a case where something happens on location and they want to go past the policies of the service company and or the operator and chase down a private investor for their $100,000 that they put in. But technically, that's what it means to be a GP. But it's important to understand that's how you manage that risk, right? Because even as an operator, right, I don't want the risk of the drilling company and their 20 employees on location, or when the completion is going on and we hire Liberty or Schlumberger or Halliburton, and they've got 20, 30 guys with massive rigs on location with 24/7 operations for a week straight. I don't want that liability. Invito Energy Partners doesn't want that liability. So, right, if something goes down on location, it's their insurance policy, and that's why that master service agreement is so critical. That's how you manage that. That's how you manage that risk as a GP.
Yeah, and I think realistically, risk management, risk mitigation, it kind of comes in layers, and I think that's kind of what you're talking about is, the existence of these agreements, the existence of the insurance policies, and of course due diligence. There are layers of risk mitigation that you're talking about. That makes sense. I think that's a good. I might point in the future when I get asked that question. I'm probably going to point them to this conversation because I think that was really well explained.
And by the way, that's another, just to point to the initial due diligence of the sponsor. Real quick on this one, when you're looking at someone in oil and gas, it's important to see what their background is. So if they've never worked at big companies before, right? So like my partner Jared, who's worked for Encana, Unit Petroleum, publicly traded E&Ps, our production engineer, they have a lot of it. When you work for the bigger companies, you learn the health and safety and environmental rules and regulations and procedures that you put in place on location. You're not doing fly-by-night willy-nilly where you're not having your morning safety meetings, your after safety meetings. You don't have your documented, set policies and procedures in place. That's another way you obviously manage risk on a drilling location, is to make sure you have all the policies and procedures in place. And there's no better training place than the big publicly traded companies, right? Because they're over the top with that stuff. So if whoever's operating the wells has never worked for anybody but themselves or small companies, they probably don't have that experience. They were never forced to do it. And quite frankly, they probably skirt those because it's costly.
Right. Yeah. It's I think with a lot of small businesses, the risk mitigation strategy is to fly under the radar, right? And a publicly traded corporation obviously
can't get away with that.
Right. Well, we're almost out of time, but I want to talk about Invito, and we talked about this a little bit, but I want to go a little bit deeper into your strategy and your investment offerings to the extent that you can talk about them here. Tell us more about Invito.
Yeah. So Invito Energy Partners, really, I think I made the mention when I was at the one company who raised a lot of money in the private space. The genesis for Invito really came from my time there. Jared and I's time there was my partner, because part of our job was evaluating assets and doing the underwriting on assets. And what we learned was, and after reviewing a lot of private placement memorandums in the space, what we learned was there's too many fees built into oil and gas deals. So it's really, it's unique and odd, and to me in different ways. But I've never seen a commercial real estate deal where someone's taken 20, 25, 30% of your money up front and stick it in their pocket. But that's very common in oil and gas. And so when you're dealing with a declining asset such as oil and gas, and you read the PPM and you realize that there is 15, 20, 25, 30, sometimes higher fees on the front side, meaning your dollar becomes 80 cents or 75 cents before you even get started, that makes it very difficult to perform. So Invito was really born out of the idea of, can we bring an institutional-like product to the retail investor? In other words, if you are an institutional, there's no institutional investor in the world that would ever pay 20% in fees up front or 25% in fees up front. Never going to happen. Well, neither should a retail investor. So our deals, we have a fund, and our deal is set up to be a very low fee structure fund. We only have a 4% fee up front. So all of the capital goes into acquiring working interest in wells. And that's what we do. So our job as asset managers and fund managers is to take the capital and deploy it into the wells that we believe provide the best return profile in terms of return, but also managing the risk. So we focus on resource plays. We don't do any wildcat or exploratory drilling. We will participate in the wells that we drill, but we will also participate in other people's wells, most of the larger E&P companies, so that we can target tier 1, tier 2 acreage, and we can get diversification into our fund. So we have a very low fee structure. The way we make money is we're aligned with the clients. When the distributions start, we take a piece of the distributions. We take 13%. The rest of it goes to the client. That's how we make money. So we're aligned. I spoke about this at the beginning. If you're looking into private placements, you got to understand how the sponsor's making money, and is it making money the same way that you're making money? And so we feel that creates that alignment. Get rid of that issue of too many fees on the front side, and then create diversification by doing operated and non-operated projects. And then we focus on oil. So we'll focus on the 4 or 5 major oil basins across the country, and that's where we're going to deploy the capital.
So
we have a fund open now.
Yeah. Okay. So that's interesting though. So you're going to deploy capital or invest in 4 or 5, 4 or 5 major oil base. I mean, that's pretty substantially diversified for, a private fund in my experience, where a lot of, they're not single asset funds, but they're typically focused on that, single region.
Yeah. We're not a project. This isn't a project-based investment. We are a fund. So our job as fund managers is to deploy the capital into the highest quality assets we can find. So if that's in the Powder River Basin in Wyoming, because it's a great operator and a great risk profile and a return, then we'll invest it there. If it's in the Bakken and the Dakotas, we'll go there. If it's in the Permian in New Mexico or Texas, or the Eagle Ford in Texas, then we'll do that as well. So it's really about finding the highest quality assets, which that's what our background is. We know how to generate the deals. We know how to underwrite the deals. And so that's what we bring to the table in terms of deploying the capital. And then, of course, if you're looking for 2023, yesterday was tax day. We talked about this, right? Mm-hmm. Yesterday you had to was the last day to get your tax returns done for 2022. You got a couple months left to figure something out for 2023. So if you're anticipating a big tax bill, I would say oil and gas is something to consider if it's suitable for you as an investor. You have to be accredited. But the other one I would say is big. You have to be liquid, right? Because these are not liquid investments. You can't make $100,000 investment and call up and go, "Hey, 6 months from now, I need my money back." It doesn't work that way. So if it's suitable and you have the liquidity, it's a great consideration for a portfolio.
And one more question about the investment offering itself. Is it an open-ended fund, or do you plan to do multiple funds?
It'll close December 31st. So we always close the fund December 31st, and then we'll open a new fund for 2024, probably in March. We don't cross over calendar years from a tax basis because the K-1s get really difficult to prepare.
Got it. Okay, that makes sense. Well, Steve, we're out of time, but my last question I want to ask, where our audience of high net worth investors and industry professionals can go to learn more about Invito Energy Partners.
Yeah, they could just go to Invito, INVITO, EP, edwardpaul.com. And there's plenty of places to click on there. And I have an ebook that I wrote on there on taxes and wealth. They could download that. There's a document called a special report, or there's a button for current opportunities, which will take you to our online virtual data room. So invitoep.com is an easy way to go check us out and give it a look.
And I'll be sure to link to all of those resources in our show notes, which are always available at wealthchannel.com. Steve, thanks again for joining the show today.
My pleasure, Andy. Thank you so much for having me.